Many investors have been caught off guard by sharp falls in global markets triggered by the biggest ever points decline in the Dow Jones index during a single trading day. On Monday, the leading Wall Street index tumbled almost 1,600 points at one stage, but recovered to close at 24,345.75, 1,175 points down on opening. The FTSE 100, the UK's blue-chip index, dipped 2.5% to 7.079.41, its lowest level since late 2016. Investor fright elsewhere in Europe saw markets in Germany, France, Italy, and Spain dip by more than 3%. Meanwhile in Asia, Japan's Nikkei 225 index and Hong Kong's Hang Seng fell 4.7% and 4.5% respectively. So what should investors do now? The first thing to do is establish why markets are down in the first place. The sell-off began last week Friday after official U.S. government showed a higher-than-expected uptick in wage growth, which raised expectations for a quicker-than-anticipated rise in interest rates to tackle inflation. Computer-driven trading is thought to have exacerbated the fall this week. The panic that gripped investors yesterday has shown signs of abating overnight, with some markets recovering lost ground. However, fears are growing that global markets are on the brink of a greater downward spiral following an extended bull run that has seen many indices climb to new record highs. The key is to avoid knee-jerk reactions. Analysts have warned that stock valuations were stretched and that a correction 10% from a 52-week high was overdue. However, rhetoric from the city suggests that the downturn suffered by global markets in the past few days is a temporary spasm rather than the beginning of an extended bear period. James Bateman, Chief Investment Officer for the multi-asset business at fund manager Fidelity International, said, "Let's be clear, in the long span of financial history, this is not news. Yet in a world where the concept of a correction almost feels alien, and where equities felt like an unstoppable one-way bet for a while, the normality of a setback can feel more painful." Holding this course as volatility eases won't seem easy, but at this stage of the cycle, the money is made by keeping your head when others are losing theirs. The pullback in the FTSE 100 has been driven by the strengthening of the pound, according to Ben Yearsley of advisor Shore Financial Planning, adding, "Don't forget that over 70% of FTSE 100 earnings are derived overseas, so when sterling strengthens, those earnings are worth less." Before tinkering with your investments, think about whether your portfolio reflects your attitude to risk. It is also worth factoring in your investment time horizon. History shows us that markets grow over time, which bodes well for those who aren't seeking to withdraw their cash anytime soon. In the same token, if your investment horizon is fast approaching, you need to think about whether you can stomach periods of volatility and consider putting your money into safer assets. beware of overtrading, because the costs involved in doing so can make a considerable dent to your take-home return. Alex Scott, chief strategist at Seng Investment Management, said, "Our strategy over recent months has been to operate with some caution, to participate to a degree in the very strong stock market momentum, but to remain underweight equities overall, and looking to include other defensive measures where possible." "We have been very wary of government bonds, especially gilts and European government bonds, where yields remain too low. We have built up allocations to alternative strategies, which aim to be uncorrelated to the direction of equity and bond markets, and may be partially sheltered from an equity market shakeout such as we are now witnessing." Finally, we have continued to hold high levels of cash and very short-dated bonds, as high as 12% in a balanced portfolio across cash and short-term bonds currently, awaiting more advantageous opportunities to invest. These may soon appear. It also pays to have a contingency plan for when markets plunge into bear territory, or, worst still, face a full-on crash. Read our guide on how to create an investing plan B strategy.